Hi everyone. Welcome to this episode of Personal Finance Podcast. In this podcast series, we always focus more on investor management rather than investments management. Our aim is to try and understand our investment behavior, our biases, what we can control, and what we need to learn beyond the daily news and headlines we are all exposed to 24/7. So what are we talking about today? That same thing that everyone is talking about, right? The war that was supposed to change everything, but just didn't. 2 years ago, investors were convinced the world was heading into another major crisis. First came the Russia-Ukraine conflict. Then the Middle East tensions intensified. This year, the US-Iran conflict escalated dramatically, with fears of disruption in the Strait of Hormuz, a key global oil route. Experts predicted soaring oil prices, runaway inflation, collapsing markets, and even a global recession. Many investors became nervous. Some wanted to stop their SIPs, others wanted to wait on the sidelines. A few felt India had become too risky. They started looking outside the country. The question everyone was asking was simple. How can markets do well when the world is falling apart? And we are here today. The US-Iran conflict intensified, yes. The concerns were reasonable, yes. If the Strait of Hormuz is blocked, nearly a fifth of global oil supply could be affected. High oil prices would hurt India because we import most of our crude oil. High oil also means high inflation. Higher inflation means higher interest rates, and higher rates usually means lower corporate profits and weaker markets. The chain of logic seemed perfect. The media amplified every development. Investors imagined worst cases. Many delayed investments waiting for clarity, but markets do not wait for clarity. Markets move ahead despite uncertainty, and that is exactly what happened. Despite all this geopolitical noise, while at the peak of global uncertainty, Nifty fell 11% in the month of March 2026. And it triggered fear of further fall in Indian market. But it surprised everyone. It bounced back sharply in the month of April and rose by 8%. And since then, it has been quite flat. Indian companies continue to deliver earnings and profit growth. In fact, the average profit growth of mid-caps is somewhere between 18 to 24%, and Nifty 50 is about 8 to 10%. Infrastructure spending remained strong. Domestic consumption held up, and India continued attracting long-term capital. Even during phases when foreign investors sold heavily, domestic investors kept investing. They provided a powerful cushion to the market. Indian SIP inflows have consistently broken records, remaining steadily about 30,000 crore monthly till early 2026. FDI in India rose from almost $80 billion to nearly $95 billion in just 1 year, a growth of more than 17%. In other words, while many investors were asking whether they should stop investing in India, global corporations were investing more money. And remember, FDI is not hot money. It is not a trader buying shares today, selling tomorrow. FDI is money which is used to build factories, data centers, technology hubs, manufacturing plants, and businesses. These investors commit capital for 5, 10, even 20 years. So while headlines were screaming about war, long-term global capital was quietly voting in favor of India. Meanwhile, some of the biggest fears never fully materialized. Oil prices, yes, initially spiked, but supply chains adjusted, alternative routes emerged, inventories were used, and prices eventually cooled a bit from the panic levels. In fact, even as headlines remained alarming, negotiations and ceasefire efforts have begun emerging between US and Iran. Also, if you look at the history of Indian markets over the last decade, every year we have seen volatility due to various reasons, sometimes local, sometimes international. But Indian equities and equity as an asset class has always come back stronger and recalibrated itself to the changing world order, continued to provide long-term inflation-beating returns. In fact, even after factoring the impact of high energy cost on India's situation, RBI estimates that India's GDP will grow at 6.6%, which continues to keep India as the fastest growing major economy in the world. So the lesson? Markets price in fear much faster than reality unfolds. Imagine two investors. Imagine there is an investor A. He stopped investing because the news looked frightening. Let's say you're the investor B, who continued investing every month through SIPs maybe. Investor A felt safer. Investor B felt uncomfortable. But today, the investor B owns more units purchased during those periods of uncertainty and volatility. History repeatedly shows that the biggest market mistakes are rarely stock selection mistakes. They are timing mistakes, waiting for certainty, waiting for the war to end, waiting for elections, waiting for inflation to cool, waiting for the next budget. Because certainty always arrives after all markets have already moved. The US-Iran conflict reminds us of something markets have taught investors for decades. Every crisis feels unique. Every crisis feels permanent, and every crisis convinces us that this time, this is different. Yet businesses continue operating, people continue consuming, economies continue adapting, and markets continue looking ahead. Because in investing, the future is always uncertain, but discipline, that has always been rewarded. And perhaps this is the most important lesson from this entire episode. The headlines were about war, but the real story that I'm talking about is investor behavior. There's something very interesting about the way we think about investments. Consider property. When someone buys property, they don't expect it to double in a year. They don't check its price every morning. If the property market remains flat for 2 or 3 years, they don't rush to sell. In fact, people are comfortable holding real estate for 8, 10, even 15 years. They patiently wait through good times and bad, even when there is no buyer, even when the prices stagnate, even when the rental yields are low. Because somewhere in their mind, they understand that this creation of wealth will take time. But when it comes to equities, the behavior is often very different. If markets don't move for a year or two, anxiety begins. If there's a correction, investors question their strategy. If geopolitical tensions rise, they wonder whether they should stop investing. Why do we give real estate a decade to prove itself, but we give equities barely a few months? The answer lies in visibility. Real estate prices are not flashed on our phones every second. Stock prices are, the markets are. And the constant visibility creates the illusion that something must be done. But just because we can see the price every day doesn't mean the value of businesses is changing every day. If you treated your equity portfolio the way you treat a property investment, many investment decisions would become easier. You would focus less on this month's returns or this year's returns and more on whether the underlying businesses will be in 5 to 10 years from now. You would focus less on this month's return or this year's returns and more on where the underlying business could be 5 years from now or 10 years from now. So you would worry less about wars, elections, interest rates, and short-term corrections, and you would allow compounding to do what it does best: work quietly over long periods of time. The irony is that among all major asset classes, equities have historically rewarded the patience the most. Yet, equity is given the least patience by investors. So perhaps the real question is not whether the markets can withstand a war. The real question is whether the investors can withstand uncertainty long enough, benefit from the eventual recovery. Nobody plants a mango tree and digs it up every month to check whether it's growing. Yet that's exactly how investors treat equities. Wealth is created not just by choosing the right asset, but by giving it the time it deserves. Think about that. That's my final thought. Thank you for listening in. God bless.